Thank you very much, and good morning, everyone. Sorry for not speaking Polish, obviously. Thank you for the great welcome. It's the first time I'm here in Sopot. I'm amazed by the beauty of this place. I hope I will be able to come back one day with a bit more time. Also happy to be here to be able to present you with the hot issues, what's going on at the level of the EU in the insurance and pension sector at the moment, focusing, as you will see, on Solvency II and retail strategy at a moment where I think we are at celebrating the success of Polish accession to the EU. I've seen the posters on the road. We have the elections in a few weeks and we have the anniversary, so I think that makes my presence here even more important, and I'm happy to represent the European Commission in this context. But let's go back to the presentation I would like to make today. As you can see, I've brought some slides just to make it maybe a bit structured. I hope you will be able to follow me. So, as I said, I want to present you with what's going on at the moment, the key issues. I will not be able to cover everything, obviously, and I apologize for that. But I noted, for instance, from the speech of Minister Drop that these are also issues which are in the mind of the Polish authorities, so that's very good to have this convergence. I would like first to start with a bit of a, let's say, economic perspective and a positive message about the European insurance industry. It's a very solid industry, and as the figures show, in terms of ability to have, high capital, high solvency ratios, since the introduction of Solvency II in 2016, we see really that we have a very solid industry who is able to sustain very high level of solvency, even, and that's also very important, and that's actually the key issue, during times of crisis. As you can see here, for instance, during the COVID period, although obviously the industry got the hit and was also touched by the crisis, it did not mean that its solvency went down too low, and it proved that it was able to withstand the shock. And again, that was exactly what Solvency II was about. And that also slides illustrates the evolution of the SCR ratios a long time. So basically the message here is to say that we have a framework in place which is solid, which is internationally recognized as being a state-of-the-art prudential framework. So I think we have to be happy about it and have to be proud about it. But of course, this does not mean that we have to be complacent, and this does not mean as well that there are no ways to improve it, and maybe to look at this issue of high prudential requirement, high solvency ratios. There's been a lot of debate in Europe, and the industry stakeholders in particular consider that this is a bit too high, that the framework is too demanding, and that it kind of refrains the capacity of the industry to do its job, to provide long-term products, but also to help, and that's very important, even more now in the post-COVID environment, and also in the context of the climate crisis. So the idea is to really make sure that the industry is able to contribute to the financing of the economy and the dual transition towards, a climate-free, climate-neutral economy, and also embrace the digital transformation. So that is basically the heart of the discussions which we had in the context of the Solvency II review. Try to find a more balanced approach in terms of capital requirement and make sure that the industry is able to contribute to the big political priorities of the European Union. And this is basically an illustration of the final product, so the result of the negotiation that ended in December last year. This is on what the European Council and the Parliament have managed to agree. As you can see, first there is an agreement that there was margin to reduce the capital requirements to empty around 45 billion euros in additional capacity for the industry to invest. The Commission proposed something a bit lower. The Parliament pushed for more, but at the end we had this balance there. Some technical adjustments I don't have time to cover now in terms of how insurers calculate the liabilities, the prudential treatment for investment in long-term equity as well. So that was really the center of the discussions, how to find the right balance. And at the end of the day, after 2 years of long negotiations, we managed to find one. I mentioned the importance of the industry in terms of supporting the green transition. There too you have a greening of the Solvency II framework, for instance, by asking insurers to produce climate transformation scenarios, to put in place transition risk management plans, something which the Commission did not propose but was introduced at the request of the Parliament. And also work for our colleagues at EIOPA, for Petra here, in terms of preparing the future. For instance, there is currently an important discussion in terms of whether or not we should put in place incentives in the form of reduced capital requirements for insurers to either invest more into green assets or to divest from so-called brown assets or assets which would not help with the transition. So why this is not a revolution in the framework, this is a notable evolution. Quite an important aspect as well that was debated in the context of Solvency II is the need for more proportionality. I said that Solvency II is the state-of-the-art prudential framework, but it's also a quite complex one, sometimes difficult for all types of business in all member states to apply. So this is why we have put in place a framework that would allow for simplification of some of those requirements. And this is sort of put in place in 2 ways. First, we have higher the thresholds to exclude the companies which are too small and for which applying Solvency II would not be a good idea. And second, for those who are covered, we have put in place an automatic system of qualification of what we call small and non-complex undertakings, for which a set of simplified requirements would be proposed with a view to make the application of Solvency II for them easier. So that's quite an achievement of the framework, and that was also the subject of intense discussion. Petra already mentioned the need to improve supervision. She covered already quite a lot of those points, but we also wanted to try to take a step further there, not maybe as far as we wanted, because we also faced some resistance from the member states to grant more powers to EIOPA in particular. But at the end of the day, we managed to take a step, but maybe again, not as far as we wanted. There would be better cooperation between supervisory authorities, some additional powers for EIOPA, and also emergency powers in case of crisis like the COVID one. Very briefly, I have to mention there as well the second act, which has been approved together with Solvency II, which is the Insurance Recovery and Resolution Directive, which is also quite a novelty, and which will introduce harmonized rules at EU level in terms of when, how insurance companies have to prepare recovery plans, and how and when supervisory authority have to prepare for the resolution of insurance companies that would face financial difficulties. Quite also an important steps in terms of completing the regulatory and prudential framework there. And quite a lot of work ahead, of course, for the member states in terms of implementation. So this is basically, and sorry for being very quick, what we've done to improve Solvency II, if I might put it that way, but the work is not finished yet. We have now to move to the second phase of the process, which is the changes to the delegated regulation, and that work will have to continue under the next mandate. Quite a few important decisions to be taken there, in particular in the context of the adjustment of the long-term guarantee provisions. There's also work for IOPA in terms of preparing regulatory technical standards on some of those issues. All this leading us to a possible date of application at the end of 2026, allowing 2 years for the member states to, and for you as the destinies of that regulation, to be able to prepare for it. So that's, again, very quickly where we are with Solvency II. Let me now move to the retail investment strategy that was also mentioned by many. That's also quite an important initiative for the Commission in the context of the Capital Market Union, and it covers, as you know, insurance because of the distribution of insurance-based investment product. The basic idea here was expressed already, is to make sure that more retail investors go towards capital markets. We are really underscoring in Europe compared to the United States in particular. We need to make sure that retail investors are more attracted, but we have to face the issue of the lack of trust, the lack of confidence in the market. Petra rightly mentioned the concerns about value for money. Do I get enough return compared to the cost I have to pay to my distributor, to my insurance company? This is the whole issue. And the feedback we get from the investor community is not very good, to be honest. I think we all agree on the diagnostic. We need to do something about it. The big question is the how, and that's the subject of the debate now. The Commission has put in place proposals on those 4 points, how to address conflicts of interest in particular. There we discussed the issue of inducements, whether it is a good thing or not. There are some experience in some countries where inducements were banned, leading to not so bad results in terms of investor confidence and access to financial markets. But of course, there's, we have to face other experience and other, let's say, feelings in other member states where this is really part of a remuneration process and more broadly of a distribution kind of architectures which we had to take into account if we want to avoid unnecessary disruption of the market. So the debate on the retail investment strategy has been quite intense, both inside the Commission and now with the co-legislators. In terms of value for money, Petra already mentioned the concept of adopting EU benchmarks, which we would like to see now being recognized in the level 1 regulation, being MiFID or the IDD, the Insurance Distribution Directive. There are two very difficult discussions, whether benchmarks should be national or Europeans, whether they should apply only or be used only by supervisors or by the companies as well. I cannot tell you today what's going to be the final results because the discussion is still ongoing. The European Parliament has taken a view on this. It has voted on the report in March this year. To be honest, coming back on quite a few of the points which the Commission proposed, including on the ban and including on the benchmarks. There are still intensive discussions with the member states, actually at this very moment. There are 2 days of discussions yesterday, I think today, with the member states. The Belgian presidency is going to try to have a common position of the member states by June. But there are two, these points I've mentioned before, are central to the discussion, and they're quite also controversial, so it's still a bit difficult to tell you today where we're going to end up with this. If I may just hint to something, my impression is that we should not expect too much ambition in this respect, unfortunately, but so be it. The issues at stake may be maybe too difficult. And maybe let me finish by a couple of points. I already over time, but digital finance was mentioned already. I think Minister Drop mentioned Doha. I would like to say a few words about the current discussion on the Financial Data Access Act, which is there to kind of build up of a market of data for financial markets users, with a view to make access to that data easier with the consent of the data holders. That's a very important guarantee. Trying to build up a system where data users and data providers would be able to design better products for retail investors and give them easier and quicker access to these products. So the Commission has presented a proposal in 2023. It's also being discussed by the European Parliament and by the Council alongside a bit the same rhythm, although we are going a bit less quick with this. There too, the Parliament has voted in April this year. The Council, for its part, is a bit behind, so the work will have to continue as well there under the next Commission. The level of ambition there is a bit high, I would say, but in terms of what would happen with insurance-related data, there is a willingness maybe to sequence the introduction of those new rules depending on the type of line of business. Let's see how it ends up with the discussions. And finally, a word on climate resilience, a topic on which many of us have been working in the past years, including, of course, colleagues at EIOPA. The Commission also wanted to bring its kind of brick to the wall there. I've mentioned what we have done under Solvency II, but together with colleagues in DG Climate, the department of the Commission responsible for climate action, we have decided a year ago to set up a climate resilience dialogue, bringing together several stakeholders, including EIOPA in particular, to discuss this issue of the climate protection gap. As mentioned on the slide here, a very limited marginal amount of natural catastrophe events are being covered by insurance today in the EU. There is a big gap to fill, and together with these stakeholders, we're trying to find ideas in terms of prevention, adaptation, better improvement of the type of insurance products that can be provided to our citizens, what can be suggested in this respect. We are expecting a report very soon now, either in June or July, with some concrete suggestions and ideas, hoping that they will be able to fit the reflection of the European Commission for the next term. And this is where I would like to finish. Sorry for being a bit longish. I've been looking at the past. The future is ahead of us. There's been a lot of activity under the next Commission, probably the past Commission. Probably the next one will have to be a Commission of consolidation and regulatory pause. But we'll see, and I think we're going to discuss this in the panel during the afternoon, and I'm looking forward to it. And I thank you again for welcoming me here and for your attention during this presentation. Thank you very much.